Hello and welcome to SwitzerTV Investing. I'm Peter Switzer, and on tonight's show, Bayliu of Tribeca Investment Partners and Julia Lee of Berman Invest will look at Megaport, Atrium Coal and Andromeda Metals. And they share with us what they like right now, with Bayliu assessing Treasury Wine Estates and A2 Milk. Have the bad boys of Beijing created a buying opportunity with these two stocks? Their share price has fallen. Is this a buying opportunity? That's the question I'll ask Bayliu. Paul Rickard looks at two stocks to sell and two stocks to buy, and they're very big names, and they're stocks that he's liked as well. Rudi Filapek-Vandijk of FN Arena tells us how to make money out of this rotation trade, out of stay-at-home stocks into the reopening trade stocks. And then I blow up about a tweet regarding Mesoblast, where someone actually said they felt sorry for people who got in at $5 and saw the share price fall to $3. Now, when you go into the stock market, it's a gamble, it's a risk. And it's not like going into a term deposit at a bank. If a bank didn't pay back your money, that would be something you feel sorry for. When people search for higher returns by going into the stock market, they have to understand they can win or they can lose. And if they lose, it's kind of bad luck. And particularly when you go into a company like Mesoblast that has to get the FDA, the American Drug Assessing Authority, to give you a tick, that's a really big gamble. And so people out there who want to get really antsy about a stock that's mentioned on this show that doesn't do well, it's a gamble. We look for winners, and most of them have won. And by the way, Mesoblast, we started talking about when it was $1, $2, $3, and it's now $4.16. So you can't win in this game when it comes to Twitter, but the bottom line is we do our best to try and find companies that are of good value. Most of the time it works out, sometimes it doesn't. If it doesn't, I'm really sorry for people who lose money, but you don't go in the stock market if you're going to cry if you lose. Simple as that. So let's get on with the show. Our first guest is Julia Lee from Berman Invest. As always, Julia Lee joins me at the beginning of the show. Great to see you, Julia.
Great to be here, Pete.
So, Julia, the market started up and then it went off the boil and then really went for a slide towards the end. What do you think's driving the market at the moment?
Look, Pete, I think it's perfectly normal to see these pullbacks, especially when you've seen the best monthly performance for the Australian share market since March 1988. We've seen the Aussie share market up by 10%, and which is an incredible performance. But when you see such a strong rise like that, it's normal to see a bit of a step back and for people to take account of what's happening in terms of valuations and the market. So we've been moving steadily into cash. We're in about 30-40% cash at the moment and looking to buy on these pullbacks. Having said that, I'm a long-term bull at the moment. We have seen a lot of money being committed to the economy through the federal government and now the state governments. And look, if we have a look across the globe, the amount of money coming into the global economy because of fiscal support is quite big. So that should be supportive of the business cycle over the next few years.
Yeah, it's great to see I've got another long-term bull supporting me. I always get in very early, but people always accuse me of being a perma bull, which is not true. But in this case, I'm glad you're joining me. Now, Julia, in terms of the cash you're holding, as a fund manager, you want to take your profit and then you wait to see other companies that you might want to buy. I'm going to ask you about that in a moment. I just want to address the three companies that came up to us in the Boom Doom Zoom show. And I've got Bayliu of Tribeca Partners to answer the same question as well later on the show. But so what do you think of Megaport? Is this a company that's been on your radar screen? Do you like it going forward and so on and so forth?
I do like the company. Look, I think it's in an area which will continue to grow. And if you have a look at Megaport, basically you don't have to buy the hardware to connect to data centers, and you can connect to multiple data centers. So not only can you transfer data from yourself to the data center, but from data center to data center. And this type of service is only going to grow in terms of needs and usefulness. So the growth is looking quite good, I think, for Megaport. The difference is that when I see a company that I like with a strong growth outlook, I also like to see the share price moving up. And unfortunately for this one, we've seen the sentiment turning in terms of some of the tech stocks. And it's not just Megaport, it's the whole tech sector, it's big tech, it's NextDC as well. So look, I'd just be waiting for that inflection point in terms of price. But I have to say, I have been watching this one again, Pete, because the price is getting really interesting down here for me. And if I saw that turning point, I'd be jumping right back in.
Okay, that's first one. Atrium Coal. Now, I know you jumped on Whitehaven Coal a couple of weeks ago and it's been going well. Have you got a view on Atrium?
Yeah, we bought into Whitehaven Coal and we actually took profits on Whitehaven Coal only because it's gone up so much in the space of a couple of weeks. So Whitehaven Coal, I think today was down by around about 10% on the back of China's move, which is unusual because Whitehaven only gets about 2% of its revenue from China, and yet it was sold down with all the other China-related stocks because of the escalating trade tensions between Australia and China. This is another one that on a strong pullback, I'll be looking to add back into and jump back into because, look, I think it is undervalued at the moment. We have seen both thermal prices as well as coking coal prices increasing in value and recovering, and that should bode well for Whitehaven Coal in the short term. I'm not a long-term believer because I think we are shifting away from coal, but I think in the short to medium term, Whitehaven Coal will do well. We have a look at Atrium Coal. ATU is the stock code. This is a little bit different. It's not producing as yet. So we're looking at a project that's moving into production probably over the next 5 to 6 years. So this is in Canada, which means, yes, it's reacting to the coal price recovery, but not really as much as a Whitehaven Coal or a New Hope Corporation. And that's because it's not producing. So really you're buying into prospective cash flows and where you think the coal price is going to be in 5 years' time. And this is really a coking coal project. So coking coal is used in the area of steel rather than electricity. And look, this area is looking good at the moment because I believe governments will try to build their way out of the recession, the COVID-19 recession, and that's good news for steel and coking coal. However, I don't know where the global economy is going to be in 5 years' time.
Okay, good point.
I prefer a producer rather than a prospective project.
Okay, and finally, Andromeda Metals.
Yes, this is an interesting one. I mean, its main product is kaolin clay, and if you have a look at this clay, you usually get tiles, but this one in particular is tubes, which means you can use it for higher quality uses. And especially in the area of nanotechnology, usually you see this clay being used in things like ceramics as well as paints. But look, I think the nanotechnology area is quite an exciting area to be. So things like hydrogen transportation, we are looking at different types of fuels now and transporting those type of fuels. So look, I have to say this one actually looks quite interesting. It is a bit too small for me to invest in because I concentrate on the ASX 200, but I like the story, I like the growth profile, and I like that it does have also access to some other projects as well, mainly gold and copper, but its key area and its core focus is kaolin clay.
Okay, one last one, the stock that has grabbed you lately.
I have to admit, I took profits on CSL around about $3.20, but it's back below $300. So if I saw it getting back to about $2.90, I'd be another buyer of CSL. And look, I've got a whole list of companies that I'm looking to add to during the pullback. I still like Lynas, the rare earth stories with these escalating tensions with China. I think they will continue to see strong demand, and especially with our reliance on tech. If we have a look at rare earths, they're used in batteries, electric vehicles, our phones, laptops, anything tech related you need rare earths for. So still liking Lynas. Fletcher Building still doing well and in an upcycle there. But look, we've had an absolute blockbuster November. It's been a phenomenal month. So we've taken a bit of profit, but on a pullback, and I'd expect to see the market pulling back around about 5%, would be adding to our positions.
All right, one quick one before we go. Treasury Wine Estates and A2 Milk. Clearly copying it from the, as I call them, the bad boys in Beijing. A2 less so. But do you like these companies, if someone was a buyer and holder, are we getting that sort of territory for someone to buy it and say wait 1 year or 2 years and you'll probably be happy that you did?
Well, Pete, I don't like losing money, and unfortunately, Treasury Wine Estates at the moment it's like catching a falling knife. So I'd prefer to wait for a little bit of stabilization. But Pete, I love drinking wine, and the thing with wines is it's either made to drink now, or you can store it and it gets better over time. But the wines that are made to drink within 1 or 2 years, if you store it, it's terrible after 5 years. You have to throw it away. And the thing with Treasury Wine Estates, its inventory is probably worth about $2 billion. About $1.3 billion of it is its luxury brands like Penfolds, where you can store it away and that's okay. But the rest of it, you have to drink it. So, if we have a look at China, it makes up 30% of earnings for Treasury Wine Estates. With these tariffs, it's unlikely that this inventory is going to make its way to China. If you try and resell it, it's probably already labeled in Chinese, so you're going to have a problem redirecting it. So I would say that they're looking at a write-down of about 150 million to 200 million. Possibly a capital raising. At this point in time, you're probably just going to see the dividend suspended. But if things get worse, you could see a capital raising over the next 6 months as well.
Quickly, A2 Milk.
A2 Milk's a little bit different in that it does rely on that Daegu market. So as we see borders reopen, we could see growth coming back to this one. So it really depends on how COVID-19 pans out. But with a vaccine on horizon, there's probably some upside here in 2021.
As always, Julia, thanks for your observations.
Thanks, Pete.
This episode was brought to you by WCM Investment Management, a California-based global equities manager with an outstanding long-term track record. This chart shows the significant outperformance of WCM's quality global growth strategy over the past 1 year, 3 years, 5 years, 10 years, and since its inception. Investors can access the strategy via the ASX with their choice of an exchange-traded managed fund, WCMQ, or a listed investment company, WQG.
Well, despite the coronavirus, we are in market bounce back big time, and we're seeing the best rise in the ASX 200 index since 1988. To talk about this and a whole lot of other things, we have Rudi Filapek-Vandijk, the founder of FN Arena. Rudi, thanks for coming on the program.
Well, Peter, I had a spare 5 minutes and I thought, what a better way to spend them.
Yeah, well, I'm going to take you for more than 5 because you're worth more than 5 despite that backhanded compliment of yours. Listen, okay, this big monthly rise, around 11% gain. Today it's down, but it might end up being 10%. It's still a massive rise in a month. And we're getting closer and closer to where we were before the coronavirus. Is it justified?
That is the $60 million question. But let me start by the first observation, and that is, I'm old enough to remember that 10% was what we would make in a year, if not sometimes in 2 calendar years. Yeah. And now we have a month, we have 10% or around 10%. Probably good for people to understand what is the underlying dynamic behind what has happened. Is that I've talked about this a couple of times in the past, and I write about this regularly, and I'm sure I'm not the only one who talks about this on your program, is that over the past 7 years or so, the share market has increasingly become very polarized in a very simplistic format between winners and laggards. And that gap, the difference between the two in terms of valuation and in terms of share price performance, had possibly been pushed to an all-time extreme wide. It has never been, the gap between those two sides of the share market has never been as wide as it was in 2020. And what that has done, it has set up a massive response in narrowing that gap in November. And that's why we get such a big rise in the share market, but only from the companies and the stocks that hadn't performed that well over the past few years, including in 2020.
Yeah.
So what we have seen is, for example, if you had done well with stocks like a Woolworths or a ResMed and an Altium, for example, then you would not have had such a great November. But if you own stocks like a Vicinity Centers or a Westpac or Woodside Petroleum, Oil Search, then you absolutely had a fantastic November, one that you would like to take in your Santa sock for the Christmas evening and talk about it a lot.
Yeah. Well, it's interesting, Rudi. Maureen Jordan, my wife, who you know well, about a year or so ago took over the editing of the Switzer report, which meant that she was reading every, 3 times a week, the recommendations of myself and Paul and Tony Featherston and James Dunn and yourself. And Maureen is an executor. She's executed me plenty of times, but she also bought. So she was being given the observations that this was the time for stay-at-home stocks, but in the future there will be a rotation into the reopening trade, and that's what she bought into. So she's had an unbelievable November because of her positioning into those sorts of companies. And so you talked between winners and laggards, but it's a rotation. And really, I can remember when I was doing the program on Sky, the Sky Business program, when we came out of the GFC, the value fund managers, they looked like geniuses, didn't they? They made money really well for 2 or 3 years, but then the growth stocks, the tech stocks took over.
It's that dynamic that is basically at play here as well. You're very well right. If you come out, the problem with value stocks is, in generalized terms, is that if you move into a recession, you're going to have a really bad time. And that's what, amongst other things, we saw that in the GFC, we saw that in early in the year as well. But when you come out of a recession, then those stocks should have a jolly good time.
Yeah.
And it's that dynamic that fund managers are now banking on. And when they look forward to 2020, they're hoping that can remain longer. I have to say, it is less straightforward now than it was in after the GFC. There's a little bit more intricacies happening here. But in a generalized term, I think that the gap between the winners and the value stocks, I think that gap that had to narrow and has to narrow to a certain extent. I'm not a believer that we will see a complete trend reversal from here. More needs to happen for that. But that gap that narrows, that would almost be a given, I think.
Okay, let me put you on the spot. Okay, so we've got those stocks that did really well during the stay-at-home phase. Now we've got the reopening phase stocks that will do well for a while until they become overpriced. But the stay-at-home stock, give me 2 or 3 stay-at-home stocks that you think will have, in a sense, created a new relationship with the customer base. And so over 2021, 2022, they won't rise at the same rate as maybe a Webjet or Flight Centre if we start flying earlier than expected. But they will be companies, they'll be good, reliable companies that might do 5 or 10% gain over 2021, 2022. I'm thinking, by the way, a stock like Kogan might be one, even though it was once on the outer. There are going to be people who've never ever used Kogan before, and all of a sudden they know about this company because of stay-at-home stocks. But you might not agree with Kogan, but that's the sort of thinking I've got. Yeah. Some companies that were unknown become known, and therefore they have a new customer base they've never had before.
Yeah. Just as a sideway, I don't like the governance at Kogan, but otherwise your assessment is probably correct. But I have similar assessments. I think and here's the irony, Peter. Maybe some of those stay-at-home stocks became a little bit bloated in valuation, but the more they fall now, the better the prospects remain, because the prospects will remain good for those stocks and great in many, many ways.
Yeah.
So stocks that come immediately to mind are, for example, Ansell. I think they will have a complete new customer base, and their products will remain popular from here onwards. Fisher & Paykel Healthcare, which recently confirmed to basically that they now have more hospitals looking at them, and hospitals are now more familiar with their product. I also would nominate, maybe a little bit more surprisingly so, but I would nominate Woolworths, for example. You see in the past few weeks that the likes of Woolworths and Coles are out of favor. The share price is pretty much dropping every day almost. I think that has more to do with portfolio positioning by professional investors who previously went for the safe havens in the market, and they're now looking to take on more risk. And that money flowing out is basically putting those share prices under pressure. But those share prices will recover because they will have a fantastic year-end and a fantastic start to the new year.
Yeah.
So that's a temporary effect, I think. Pretty certain they will. I mean, the context for companies like a CSL, like a Zero, for example, like a Technology One, the context hasn't changed.
No.
The only thing that has changed now is that money is flowing out of those stocks, moving into other stocks, but that's the only thing you can hold against these companies. These companies still have sustainable, strong growth for multiple years ahead of them.
Yeah, and funnily enough, as I listen to you, Rudi, and this is the only reason why I hang out with you, that when I listen to you, I get even smarter ideas than you. But yeah, so you're a catalyst. You're a catalyst for me being even smarter, because I generally write stories to the people I write to on the Switzer Report and also on the TV show. When the market is selling off willy-nilly like it did in February to March, I always say, and you've seen me write it, this is a great buying opportunity as long as you're buying quality companies. But I don't ever, during a rotation period, write, there are stocks like the ones you just mentioned right now. They are in a buying opportunity. Even though the market's going up big time, there are still quality companies that, you're right, portfolio managers are taking their profit to go and jump into the reopening trade stocks, and those stay-at-home stocks that will do well in the future, they're in buying opportunity territory. Gee, I'm glad I invited you on the show, Rudi.
It's my pleasure, Peter.
All right, mate, one last thing before we go. I don't know how you did it, but on Twitter you brought up something around Mesoblast, and I don't know whether you were responding to it, but someone has implied that Julia Lee had compared Mesoblast to CSL, and I came back, and I very seldom do Twitter because people can be so nasty on Twitter, but I just said, by the way, Julia has never ever compared Mesoblast to CSL.
Okay.
And then,
records, yes.
and then a whole lot of people say, oh, Switzer and Julia Lee are talking at Mesoblast. No, I've got a very small holding, and I bought it the day it sold off. But anyway, go on.
I guess that can happen on social media.
Yeah.
I guess where I took a little bit of offense to it is that people were comparing Mesoblast to CSL. And I made a comment basically saying that's a silly remark to make, because you don't give your shareholders an average return of 28% a year over 3 decades, if you're CSL. I mean, no other company can achieve that. So that makes CSL special. And I still remember the times when people were constantly comparing, this is the next Cochlear, this is the next ResMed, this is the next CSL. And ultimately those comparisons are silly, because yes, right, as practice turns out, very few companies can match up over time what those companies have achieved in Australia, emphasizing what the great quality companies we have over there. Having said so, the healthcare sector in general is still one of my favorite hunting grounds on the ASX. And I think younger companies like Fisher & Baker Healthcare would be one, Nanosonics would be another one, Pro Medicus would be another one, and there's a whole slew of other ones. They could potentially develop in great companies themselves, but we need to give them some more time. And this is where the whole discussion also revolved around. In my view, I own those stocks, or I pay attention to those stocks. They represent less risk and less volatility. It's less of a binary proposition than a Mesoblast, which, as we've seen this year, can either fly very, very high and can fall very deeply, simply on a yes or no from the FDA in the United States. And for me personally, it's just the type of investor I am. For me, that's too binary as a proposition, and I therefore prefer to have, for example, a company like Promedicus in my portfolio, which is also very promising, could be a great company in years to come, but it represents less risk in from that perspective, that one no or one yes could tank the share price by 50%.
Yeah, from my point of view, I only bought $10,000 worth of Mesoblast because I was sick and tired of Julia Lee telling me for 3 years ago, a stock that was $1 became 3, became 5, became 10 or whatever. I had to get at least, but to me, Mesoblast looks like maybe Afterpay many years ago. I don't think Afterpay is going to become CBA. I don't think Mesoblast will become CSL, but it's got potential. It could actually do pretty well, but it doesn't make it a company like of CSL stature.
No, and I think you've been caught by FOMO, Peter. The fear of missing out.
Yeah, but from my point of view, it's in a speculative play. It's not my core holdings, and I guess it's consistent with what I said a moment ago. It was a buying opportunity, you know, and if these guys get one of their 3 products up over the line and really doing well, it'll justify what the $3.20 price I paid to get in. Otherwise, I lose $10,000. But yeah, some clown on Twitter actually said, think of the poor people who lost money in Mesoblast. No, when you punt on stocks, there's no one who feels sorry for you.
You should know what you're doing.
That's right.
True.
It's gambling, and only if there's corruption do we feel sorry for those poor people. But even then, you go in the stock market knowing it's a gamble going in. As Seinfeld said, when you buy a banana, you know it's a gamble going in.
Well, I have to correct you a little bit, Peter. I think when you go into the stock market and you buy stocks like CSL and CBA, it's less of a gamble than if you buy Mesoblast.
Yeah. But, you know, think of those poor people that bought CSL at $330 and they're now going to face $303. They've lost $33 per share. Gee, I feel so sorry for them. Not. Rudi Filapek-Vandijk, thanks for joining me.
Happy New Year, Peter.
Same to you, mate. Well, joining me is June Bayliu from Tribeca Partners. Her fund is the Alpha Plus fund.
That's right.
After all these weeks and years, I've finally got it right. Yeah, June Bayliu, I always like to hit you up with some questions we've got from our Boom, Doom and Zoom show. Let's just start off with those, but I do want to also talk to you about Treasury Wine Estates and A2 Milk, because they're currently in a battle with China.
They're very topical, absolutely, yeah.
And I always like buying good companies when they look like buying opportunities, but let's just talk about it later. Let's start with Atrium Coal. What do you think of coal generally and Atrium specifically?
Look, I think coal generally is, at this point, they are in a tough spot, and as the share price reflected as well, simply because, you know, the global growth, or because COVID and all of that, the global growth was cut, you know, expectations cut and the coal prices fell. And also partly because China was, you know, using its internal produced coal and refused to take a lot of imports, and Australia in particular also being caught in that, you know, the political conflict as well. So Australia, a lot of Australian coal actually sitting on the water at the moment, cannot go inside China. So, you know, the whole coal prices out of Australia has been under pressure, and recently in the last couple of weeks it started going on a bit of rally. But again today, you know, with the escalation in the political tension, that there's a lot of fear for that space.
Should we think of coal as maybe a trading opportunity, but not a long-term play because of all the negatives out there?
I agree. Well, look, that's how I perceive it. It's a trading opportunity. They look very, very cheap. So there is a bit of upside given how cheap they are compared to the rest of the market. But the challenges are that globally, because of the ESG issue and its impact on the environment, a lot of institutional investors just stepping away from those assets, and no one's really buying them. So it's not an asset that has a strong terminal value, put it that way.
Here's one that we didn't know much about, Andromeda Metals. Do you know much about that company?
Yeah, it's one of those companies that sort of sit in the space where it's a little bit obscure.
Yeah.
You know, during the strong look, I'm not you know, have a thorough understanding of the business, but I think in the environment where the metal prices has been incredibly strong, it is a business that will catch a bid. But just be mindful of some of those smaller names that you know, when the big tide turns, it can be quite challenging.
Okay, so it's a speculative company.
Absolutely.
You could win, you could lose.
That's right.
Okay, Megaport's an interesting one, isn't it? It's had a nice run, but it's gone off the boil lately. And I've just interviewed Bevan Slattery, the founder. Very interesting guy, and next week on this program we'll show you parts of that interview, particularly in relation to Megaport. What do you think of Megaport?
I love Megaport. I think it is a company of the future. If you want to future-proof your portfolio, you've got to have one of those businesses in there, and Megaport is the way to do it. It is highly leveraged to the future cloud computing, which we know is essentially storing data in a cloud. You know, when we have 5G, when we have increasing usage of e-commerce and everything data, and more we require those services. And this is the company that is directly linked to that space. Just after the you know, the Next DC. Now Next DC is like the property trust of the future, where they help to have the physical storage for those for the cloud, whereas Megaport is helping the usage of those sort of space. So it is very linked to the future growth, and I think that's the company you have in your portfolio.
Yeah, the interesting example he gave me was he said, you look at the VRC during Melbourne Cup time, they need enormous capacity to deal with the amount of interest that it will generate. But after that, they don't need it.
Exactly.
And also it made me think of Black Friday. All those retailers that need enormous capacity.
And then they don't need it constantly. Exactly.
And so that sort of solves that kind of problem that none of the big players individually can do.
Exactly, and then there's only one company. Essentially, it invented that space for itself globally. So it is actually the global dominant player in that space. So incredible amount of growth.
Okay. And I was actually talking to Rudi Filapek-Vandijk earlier today, and I've often said when the market is selling off big time, that's a great buying opportunity. Like, for example, a week after March 23. March 23, I was still worried, but a week after, I thought, no, this is probably a buying opportunity. But we do get those times, like when there's a rotation and some really good quality companies fall while other ones are being chased as portfolio managers like you take
Swing
profit.
Around. That's right.
But there's buying opportunities even when the market's rising for good quality companies that have, in a sense, people have been taking their profit, but then people like you would then buy it at a lower
when
price.
Others, absolutely. And I don't see those growth companies will be meaningfully sold off, to be honest, in the rising bull market. Next couple of years is going to look pretty good for equity market. And I think they will, it's just for, they pause for a little while the other catches up because the valuation gap got too big, but then they will rally again. So use the opportunity, sell off opportunity to buy them. Okay,
let's go to TWE, Treasury Wine Estates, being really picked on 212% tariff. Like, that's one of the biggest tariffs in modern history. Now, you've liked TWE.
Yes.
Still like it? This is a buying opportunity. You know, eventually this China-Australia problem will be solved.
Absolutely. Our investment case for this company, why we like it, is because the share price actually has started reflecting this the minute we had the rumor about this potential tariff 2 months ago. Share price would have been $20 if it not for the rumor of tariff, and now it's at $8.50, closer to $8.50. Now, $8.50, 70% of the value you pay today are those premium wine that is sitting in its cellar. These are the Penfolds, 707s, and Grange, and all of those categories, which company has clearly articulated the plan to redistribute some of this if they need to.
And then other people could buy it.
Other people could buy, absolutely, and there's no need to discount for those premium label because previously they couldn't even satisfy the demand in other markets because China was so strong, they were just shipping it there. So my view is that you're not paying much for ongoing business, and quality brand like this do not stay cheap for long, and we don't actually need the trade conflict to step down anytime soon for you to see value in this business.
Okay.
It's a great buy.
Okay, so TWE, you're giving it a tick. Let's go to A2 Milk, another company that you've always liked. It's also having a bit of a China challenge as well. What's the Is it a buying opportunity now?
Yeah, that's right. So this one, it's actually not because of China, the trade conflict and all of that. It's mainly because they did too well 6 months ago.
Yeah.
When COVID hit, Chinese mothers were just buying A2, and then they stocked up their pantry. And now that everyone's out and about, they just got a lot of infant formula.
It's like toilet paper.
That's right. So it's just going through a bit of glut at the moment. It would take 6 to 8 months to wash it through, but long-term dynamic is still intact. The latest data is that they continue to take share from other foreign brands in China, and the Chinese parents still love this brand. They continue penetration into lower tier market. Still very strong balance sheet, no debt, and the business is continuing to power on. It's just the short term. There's a bit of the earnings disruption.
It's called A2, but it's not Australian. It actually is New Zealand.
Yeah, that's right. That does show them a little bit.
NZ2.
That's right. Absolutely. Yeah.
All right. So their companies I've been talking about. Is there a new company that's come on your radar screen over the past 2 weeks since we last saw you that you like, maybe because of the rotation play out of stay at home into the reopening trade?
Look, I think, aside from Treasury Wine has become quite definitively represent a lot of value here. In terms of the value trade, look, I think Bluescope we talked to, I think we haven't spoken about this one. The earnings momentum is enormous at this point because of the spreads. It is one of the higher quality producer of those products, and still spreads looking very strong, and they just upgraded their earning twice in the last few months, and I think it's still looking pretty strong heading into next year.
We have been recommending Bluescope on the program for a few months now, but people who have missed out, you'd be saying there's still upside on your calculations.
Absolutely. These type of business, you follow earnings, and then the earnings upgrade cycle is not yet over.
Jim Bayliu, thanks for joining us.
Thank you.
That's Jim Bayliu from Tribeca Partners.
This episode was brought to you by WCM Investment Management, a California-based global equities manager with an outstanding long-term track record. This chart shows the significant outperformance of WCM's quality global growth strategy over the past 1 year, 3 years, 5 years, 10 years, and since its inception. Investors can access the strategy via the ASX with their choice of an exchange-traded managed fund, WCMQ, or a listed investment company, WQG.
Well, it's time to catch up with poor Rickard from the Switzer report, and this week he has 2 stocks to sell, portfolio stocks he calls them, and 2 to buy. Poor Rickard.
Hi Peter, look, I don't do a lot of trading in my portfolio. I tend to keep it pretty core, Peter. I think I've learnt that time in the market is more important than timing, but occasionally, it's nice to lock in a little bit of profit. Clearly, if you've got dogs, you've got to get rid of them, and if you've got underperformers, throw them out. But today, a couple that I just think it's time to got a little bit ahead of themselves, and I want to reduce back a little bit.
Okay, well, shoot.
Okay, the first one is Seek. That's the employment website. It's been up back over $26. Got sold off a couple of weeks ago when there was a scare about short sellers report from offshore sent the share price down, but it's back to it's above where it was before in March.
Before the coronavirus.
And it's investing a lot of money in the business, Peter, but for shareholders are going to have some patience, and I still think there's a bit of risk. A question about some of the brokers that maybe there's been a bit of bring forward business because of the catch up. So look, I like Seek, but at above $26, I think it's getting a little pricey.
Yeah, I've always been impressed with the Bassett brothers. They are the genuine articles, and when they've sold off, they've been good buying opportunities. But you're basically saying good quality company, probably got ahead of itself, take profit, and maybe buy when it goes off the boil.
I'll be looking to buy at the right time.
Yeah.
The other one is Xero. Now, you and I know I've been
love Xero.
A huge fan
You're
of Xero.
You're rejecting a child here, Paul.
Well, it's $135, $136, even higher.
You encouraged me when it was $70. I love you for that.
It was $80 at the start of the year, Peter. It was $8 about 6 to 8 weeks ago. It's gone crazy in the last in the last 6 to 8 weeks. Look, a great company. I think that the negatives on Xero are just a question mark about its US business. It had pretty weak growth in the US in the last half. Only 10,000 net additions. It's only got a customer base there of 216,000. So it's really a minnow taking on a giant Intuit and others, and it really needs to show that it can actually master the US. So I'm a big zero believer, Peter, but in the 130s, analysts think it's more like worth about in the low hundreds. Yeah. I'm with the analysts. I think it's just at a good dip, I'll buy back in.
Yeah, because you could get yourself the CSL problem that people were waiting for a dip and one didn't come until there was a major market.
Look, I'm not going to dump all of it, Peter, but I think if this is
so you might sell a portion of it.
Yeah, a portion, and it'll give me room back in a dip or some other more serious correction.
Okay, so they're the two you're going to sell. Two companies that you've liked in the past. What are the two you're going to buy?
Okay, the first one is NextDC. It had a pretty good run up until about October, but it's actually come off 20% since October, and that I put down totally to
I might follow you in
totally
on that
to the rotation trade, Peter. There's no other news. The analysts haven't changed their view. The company reconfirmed, gave a fairly upbeat assessment at its AGM.
Yep.
So there's no news out of the company apart from the fact we're confident of meeting our targets, which is all pretty positive. And it's down 20% in the space of the so-called rotation trade, and I think this is a good company.
So, and a lot of that sell-off could be fund managers taking profit, so they'll buy another company that's going to do well in the reopening trade, which one day they'll sell to buy NextDC again.
Yeah, and look, the reopening trade is there, Peter, but there's also this idea that suddenly we've got to find value stocks. Well, yes, we do, but also companies that can legitimately grow a business, build a business almost from scratch, add on data centres, become really one of the top one or two providers in Australia, like NextDC has done. They have 20% growth in earnings and revenue, and I think it's a great company, great success story, and it's very secure income, Peter. This is not stuff that's going to go away. No. You put a data centre and you get all the...
It's infrastructure,
It's infrastructure, right? Yeah, so it's not high-risk income.
No.
And so a 20% sort of sell-off in the space of a few weeks because of the so-called rotation trade, to me, looks crazy. And I think this is a buyback in chance.
Yeah, well, I've just interviewed Bevan Slattery from my podcast on Wednesday. He's the founder of NextDC and Megaport and Superloop and Pipeworks. Very interesting guy. And I'll be looking at NextDC as a consequence of just talking to him and listening to you. Final one, Paul.
And the second one is car sales. Now, car sales...
Which I've never talked about before.
Yeah, I haven't. I've always looked at car sales and been a bit hesitant. I always thought it was...
bit low rent for you?
Yeah, a bit low rent. I mean, you can argue it's in the same category as Seek, right? Yeah. Seek has the dominant position in online job advertisement in Australia and lots of other countries. Seek is the dominant. Sorry, not car sales is the dominant in second-hand car sales, right? Yeah. The nearest competitor is less than half of its size. So it's a bit like, the REA in real estate, the Seek in employment, car sales.
The three of them came up together.
Came up together. It's more than doubled since COVID-19, which makes me a little wary. But we had a very bullish article from Tony Featherstone on Thursday, which you can read in the Switzer report. And Tony's argument, he really likes a lot of the car companies. Yeah. What he really likes is he thinks there's a housing market boom going on, and I think he's right there.
Yeah, it crashes your wealth.
At the bottom end, and there's going to be a big wealth effect of that as people spend on things like cars and furniture, and we're starting to see that. We're starting to see strength back, and not just in the new car market, but also the used car market, where really is car sales is all about. Got a good couple of operations in South Korea, so it's actually made some progress offshore. It's probably fairly priced, Peter, but I think some of these stocks, it's on a PE of about 35 to 1. I don't think that's unreasonable.
Not for a tech stock.
For a tech stock that's consistently growing at about 10% per annum. So carsales.com is the second one. Again, I'm not going to be rushing into, but I think this is one to have a look at, and the right market day and the down day I look to buy.
Yeah, I know our fund manager for the Switzer Dividend Growth Fund has bought car sales on dips and done very well out of it. One final thing, Paul, I should throw in there is that when you look at the way this market's going right now, it is a buyer's opportunity for stuff that is a really good company for the future, but it's just out of favour because everyone's going for the rotation trade.
Yeah, and I think we might have a couple of challenging weeks ahead, Peter. I think the US is just going to... Just due, looks like it seems to me a bit of a breather's due in the US as they get more worried about COVID and the impact of, they're going to go for a whole more lockdowns and other things that are going to impact some of those figures. And we've followed, but our market looks good, but I wouldn't be surprised if we just get a little bit of the Santa Claus rally might yet come, but it could be we might have had a lot of it, and there's now time to just pull back a bit.
Yeah, I wonder if the bad boys in Beijing will get in the way of Santa Claus.
And the bad boys of Beijing could knock it out. I mean, Treasury Wine Estates today, there's still a lot of market risk on some of our China
trading companies, I guess. That's Paul Rickard of the Switzer Report. And if you want to get a free trial of the Switzer Report, just go to switzerreport.com.au. And before we go, let me remind you, tomorrow and on Wednesday, we have the Switzer Small and Micro Cap Conference. It will be, of course, online. It's a virtual conference. If you want to, and by the way, I should say, a lot of really good companies have come out of this conference before, and other ones around the country when they've been held. And they give you a chance to see companies that you don't usually get to see in newspapers unless it's a remote story. This is a chance for you to hear from a CEO or a CFO about a company, what it's doing, and what its prospects are. So you might get some really interesting ideas. And companies like Afterpay and CSL well, CSL wasn't, but Afterpay was certainly a small company and a micro company that developed. And I think going along to this conference, checking it out online, you might just see something that will be a really interesting company going forward. To register, just click on the link in the description box below as I speak. Thanks for joining us, and I'll talk to you next week.